Gallo, you're watching News.Markets. September, December, sometime next year. Does it really matter when the FOMC hikes interest rates? What about the UK, where inflation is stubbornly low, but interest rate rises are likely? Perhaps the big question isn't when, but by how much? Well, Stephen Gallo, the Forex strategist at BMO Capital Markets, is here to talk about the big picture for interest rates and what it means for the markets. Thanks for coming in. Now, this is a bit of a waiting game, is it? What cues and clues are you looking at for this hotly anticipated liftoff in 2015 we've been hearing about?
We believe that the Fed wants to get rates off zero. The Fed believes, based on indicators, economic indicators, in particular the labor market, that the rates at emergency levels are no longer appropriate. And that's simply what they've been telling us for quite some time now. So we're expecting a move in September and October, and over the next 6 months, the broad value of the dollar in trade-weighted terms, we expect another 5% appreciation of the dollar. Why not 10% appreciation? Well, some fundamentals outside the United States will continue to improve as they have done, particularly in Europe, and that will be supportive for the euro, and it will cap the dollar strength. We also think that the Fed will use a combination of the range in the federal funds rate that it's going to be targeting. So, for example, it can keep the effective rate towards the bottom end of that range, and it can also use rhetoric to slow the dollar strength down and keep a lid on interest rates. And we think it will use both of those tools at varying times over the next 12 months.
That's the FOMC, that's the States. What about in the UK?
Let me approach it from the standpoint of the pound versus the dollar cable. So we expect the Fed to lead the Bank of England. So the Fed will hike around 9 months before the Bank of England, and that will bring pound dollar down to the low 150s, we think around 152. And then we expect a hike from the Bank of England 9 months after the Fed, so roughly in May of next year. And over that period, in 9 months, we expect a small appreciation of pound dollar back to the 154, 155 area.
I have to ask you about all the excitement that's been going on in China. Will that have an impact?
I think the move from China this week took markets by surprise, certainly. But in the grand scheme of things, the move in the currency, the onshore RMB, wasn't actually that significant. And if you compare where the RMB is trading now versus a range of important currencies, emerging market currencies, G10 currencies, it's still one of the better performing currencies this year, including versus the US dollar. So at the moment, we don't expect it to have a material impact on US economic growth, net exports. But we do think that if China were to move another 8 or 10%, that certainly would set alarm bells ringing, and it could impact the pace of Fed rate hikes next year.
And of course, so much of all of this is a bit of an experimentation, isn't it? Because we've heard analysts say that all of this, the monetary policy has meant that the financial system is skewed. So does that mean when the interest rate policy starts normalising, it's going to be a big shock for the markets?
Not necessarily a shock. It will come very well rehearsed when it does happen. The Fed has been practicing for tightening, practicing with reverse repos. Effectively, what that means is that the Fed has been experimenting with what it's going to be like when it starts to drain liquidity from the system, given the fact that there's so much excess liquidity sloshing around. So it is an experiment. And once the Fed funds rate does move up later this year, we think, the Fed will be experimenting with the rate. They'll be observing the rate. It'll be learning for the first time where it's feasible to keep that rate, and it will be using various different fine-tuning operations to control the rate once it gets there. But it is an experiment because the Fed has never normalized before with this much excess liquidity in the system.
So let's talk about how to trade it. I mean, should investors be feeling their way in the same way?
We still favor long exposure to the dollar. Long dollar versus a basket of the major G10 currencies still looks to us to be a viable way forward. We would favor shorter positions in the commodity currencies and the euro and some of the ultra low yielders like the Swiss franc and the Swedish crown, more so the Swedish crown than the Swiss franc, I think, and probably less short exposure to the yen and sterling. So effectively the dollar is going up versus all of those currencies over the next 6 to 12 months. It's just going to appreciate unevenly versus those currencies.
So not a clear path, but you do expect the dollar to go up. Stephen, thanks ever so much.
Pleasure.
Yeah.